Good morning, CPA students, and that is aspiring CPA students. So it's another time we meet for this live session, whereby we'll be doing our last question for the August 2025 sitting from the financial reporting and analysis paper. So already we have done question number 2 to question number 5 in my previous sessions. So the videos are available. You can check out. So for today, let's look at question number 1 for that relevant sitting. So the question number 1, August 2025, financial reporting and analysis. So question number 1, it reads, International Public Sector Accounting Standards, that is IPSAS 31, intangible assets, requires intangible assets to be recognized if identifiable and controlled by the public entity. If done what? If identifiable and controlled by the public entity. With reference to the above statement, explain 2 components of identifiability as per the IPSAS 31. So with reference to the above statement, explain 2 components of identifiability. So I've done some points on the whiteboard, which we can use to answer that. So the first component of identifiability as per IPSAS 31, an asset is identifiable if either is separable. That is, it's capable of being separated or dividends from the entity and sold out, transferred, licensed, rented, or exchanged, either individually or together with a related contract. So identifiable assets or liability, regardless of whether the entity intends to do so. Or arises from binding arrangement. It arises from what? A binding arrangement. It arises from a binding arrangement, including rights from contract or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other rights and obligations. So those are the components of identifiable as per IPSAS 31. Then the next one, B. When an entity transfers its products to a dealer or a distributor for sale to end customers, it must determine whether the contract is a sale or a consignment arrangement. Either it's a sale or a consignment arrangement. In relation to the above statement, explain 2 indicators of a consignment arrangement. Indicators. So these are the indicators. So the entity controls the product until a specified event occurs, such as the sale of the product to a customer, or until a specified period expires. That is the point number 1. The entity can require the return of the product or a transfer of the property to another party. Then the dealer does not have any unconditional obligations to pay the entity for the products, although it may be required to pay a deposit. Let's look at C. Z Limited, that is Z Energy, has entered into a contract with GasB to purchase 100,000 units of gas at 50 shillings per unit. The contract allows Z Energy to pay a penalty of 15 shillings per unit of the gas that it does not purchase. The market price of the gas has fallen to 30 shillings. That is from 50. And the Z Energy has decided to invoke the penalty clause. You understand the penalty was? The contract allows Z Limited to pay a penalty of 15 per unit of the gas that it does not purchase. But now the market price has fallen from 50 to 30, and the Z Energy has decided to invoke the penalty clause rather than pay the shillings 50 per unit. So it is still contracted to buy 74,000 units of gas. That is after invoking the penalty clause rather than pay the 50 shillings per unit. It's still contracted to buy 74,000 units of the gas. Determine the amount of the provision that C should make in the books of accounts. So the provision it could make, the provision he could make in case of there's no income he was making out of the contract. So this was a simple explanation I provided here. The provision by C Limited. So this question number 1 was just very simple. So provisions of C Energy. So to fulfill the contract, that is C Energy needs to buy gas at what? 3.7. So to get 3.7, it's just taking the 74,000. Remember 74? That is after invoking the penalty. So now they say that the market price has fallen to 30 per unit, and C decided to invoke the penalty clause rather than pay the shillings fee per unit. It's still contracted 74,000 units of gas instead of 100. So C needs to, so for C to fulfill the contract, C Energy needs to buy gas at 3.7. So 3.7 is all about 74,000 times shillings 50. And the sell at 2.2 million, that is 74 times the 30. Remember 30 is after the price has fallen from 50 to 30. So you could buy at this and sell at this. So meaning that the cost is 1.48. The cost, that is the difference. You take 3.7 minus what? 2.2. So 3.7 minus 2.2, because now you were selling at a lower price. You were selling at a lower price. So the difference, 3.7 minus 2.2, that is 1.48. That is the cost. If it doesn't fulfill the contract, or if it doesn't fulfill the contract, it will pay 1.1. That is the penalty. That is the penalty of 15. The penalty of 15, that is 74,000 times 15, but will not earn any what? Any income. So if there's no contract he was to fulfill, remember that he has to pay the penalty based on the 74,000 units. So 74,000 units times 15, but will not earn any income. So the net cost is this one. The net cost is the 1.1 million. So C Energy should make a provision of that. You should make a provision for the onerous contract at a lower amount. That is shillings what? Shillings 1.1. I think you have understood that. So we go to D. We go to D. International Accounting Standards 2, inventory provides guidance on the determination of cost and its subsequent recognitions as an expense, including any write-down to net realizable values. So IS2 inventory provides guidance on the determination of cost and its subsequent recognitions. That is inventory. Provide guidance on the determination of cost and its subsequent recognitions as an expense, including any write-down to net realizable value. In relation to the above statement, I write 3 situations in which net realizable value is likely to be less than cost, whereby you can find that the net realizable value is less than what? The cost. These are the situations. If there's physical deteriorations in inventory, obsolescence of stock items, obsolescence of the stock items, increase in cost or a fall in selling price, then we have errors in production or purchasing. Errors in production or what? Purchasing. Then the last one is a strategic decision to manufacture and sell products at what? At low price. So that is from A to D. We do E, which is the last part of the question. E is the last part of this question. E. It needs some computations, not just theory. E needs some computations. So now we do some computations for E. We do some computations for E. We do some computations for what? For E, for part E. E needs some what? Computations to be done. So they were saying that as at 31st December 2023, a plantation consisting 100, that is X in pine trees, let's say pine trees that were planted 10 years earlier. So pine trees, 30 years to maturity. So they take 30 years to maturity, of which they were planted 10 years earlier. So they were planted 10 years earlier, but they take 30 years to what? Those pine trees, they take 30 years to maturity, and will ultimately be processed into building materials for houses or furniture. Only mature trees have established fair values by reference to a quoted price in an active market. The fair values, inclusive of the current transport cost, to get 100 logs to market for a mature tree of the same grade as the plantation is, as at 31st December 2023, 171 shillings. As at 31st December 2024, 165 shillings. The appropriate discount rate, 6% per annum. Required, estimate fair values of the plantation as at 31st December 2023 and 31st December 2024. Roman 2, using suitable computations, explain the accounting treatment of the change in fair values in the year 2024. So the first thing I can analyze the data we have, the facts in this. So this is E part of it. So the facts we know is that the facts we have is that we know that the number of trees. We know the number of trees. Number of trees, those pine trees is 100. Then age asset. So the age asset, the age as at 31st December, the age as at 31st December 2023 is what? 10 years. 10 years. You know, maturity age is 30 years. That one is given. Maturity age, meaning that time to maturity, because they were planted 10 years ago. Time to maturity is 30 minus 10. 30 minus 10, you get 20. That is 20 years. That is 20 years. That is 20 years. Then discount rate, which is given, discount rate is all about 6%. That is 6% per annum. Then fair value, mature trees. So the fair value of mature trees, fair value, that is for mature trees. These are about IS 41, agriculture. We are trying to do agriculture. So mature trees, agriculture. So mature trees. So the fair value here, I can see the one given, shillings 1 what? Shillings 171. That is for the year 2023. And the 165 for 2024. So market price include transport cost. And we know that market price include what? Market price include transport cost. Market price include the transport cost. So those are the facts we have. So the first thing we do is estimate the fair value of the plantation as at 31st December. So what they need is estimate fair value. That is what they are asking. Fair value of plantations. Fair value of the plantations. Fair value of the plantations as at what? As at 31st December 2023 and 2024. And 31st December 2024. 31st December 2024. So we can mention something here before even I do the estimation. We can say this. Only mature trees have observable market values. Only what? Only mature trees have observable. That is what you need to know. Only mature trees have observable market values. Market values. They have market values. So for immature trees, the fair value is estimated by, for immature trees, the fair value is estimated by discounting you discount. By discounting the expected mature values, the expected mature values back to the present values, back to the present values. Now this financial management applies. Those formulas for discounting, expected mature values back to the present values using the appropriate discount rate. Using appropriate discount rate. So you say that fair value. So you say fair value in mature trees. So fair value in mature trees is equals to what? Fair value mature trees. This is the formula we'll be using. Fair value mature trees times what? Times that formula for discounting. That formula for discounting, you know, it's 1 plus what? 1 plus R. You do what? Power N. That way. So which you know that R is the discount rate, N is the time. R is the discount rate, which is 6%. The discount rate. Then you know that N is the time. Number of years to maturity. That is number of years to maturity. Number of years to maturity. Number of years to maturity. So what is supposed to be done here? We do this way. So meaning that we start with a fair value for 2020 what? Fair value asset. So we can do fair value. Fair value asset what? As at 31st December 2023. Then we do 2024. So fair value 2020 what? 2023. The fair value 2023. So present value 2023 is equals to 171. That is the fair value 2023. You can see that the fair value given in 2023 was 171. It's there. 171 times 1 plus R, 1 plus 0.06. That is 1 plus that, you get 1.06. So it's all about 1 plus 0.06. So that is what is giving me this. But this one you power to N. Power N. Time to maturity. So for 2023, remember that time to maturity is 20 years. Time to maturity. By 2023. By 2023, By 2023, that one is power what? Power 20. So remember that now here, to get this, it's very easy. It's the same as saying 171. You divide what? 1.06. For us to ignore this negative, that is why I'm dividing. It's 171 divided by this. So which is equals to what? Which is equals to, if I use my calculator, I will be able to get 5.32. 5.32. Then fair value of the plantation. So I can come here and say fair value of the plantation, The fair value of the plantation, 2023. You have now to take the number of trees, which is 100 times this 5 points. So this one is so it is this one is 1.06 raised to 20. Then 171 divided by that Divide by answer. This is one about, not 5, but 53. This one is all about 53.32. So that is what we multiply with this. So that we get 53 what? 53.32. We get 53 what? 53.32. Then now we can do for 20 what? 2024. We can look for 2020 what? 2024. So it comes here and say fair value as at 31st December 2020 what? 2024. 2020. So the fair value as at 31st December 2024. So as at this date, we need to know that as at this date. Now as at 2024, as at this date, as at this date. Now the trees are at are how many years old? As at 2024. Remember that by 2023, as at 31st December 2023, 10 years old. Now in the next year, you add 1 year. By 2024, now you add 1 year. So 11 years. 11 years. So as at this day, the trees are 11 years old. The trees are 11 years old. 11 years old. The trees are 11 years old. So n, that is, so the n is equals to 19. So that is 30 minus what? 30 minus 11. That is 30 minus what? 30 minus the 11. To maturity. To maturity. You have understood that. And you need to know that. And the expected, which is given, and the expected mature price, and the expected mature price has changed. And the expected mature price has changed. That is now from 171 to what? The price given now. 165. It's given in the question. Has changed to shillings 165. 65. That one is given in the question. It's okay. So that here we say that PV 2024, the present value 2024. The present value 2024 is equals to that 165 times. Remember, it's 1 plus R. That is 1.06 raised to what? Negative 19. So it's the same. We will do 165. You divide 1.06 raised to 19. That is power 19. So this one is equals to what? That one is equals to. So 1.06 power what? Power 19. Then 165 divided by answer. That is that one is with the 1.06 power 19. Power 19. Then 165 divided by answer. That is 54. 54.1. This one is 54 point. This one 54.53. So that now the fair value of the plantation 2024, fair value of plantation, fair value of the plantation 2024 is equals to the 100 times what? This 100 times 54 point. So it will be 54.53, which you can see there's an increase from 53.32 to 54.53. So there's a gain, gain, which is taken to what? Gain to profit. So this is the treatment, gain to profit or loss. Gain to profit or loss. Gain to profit or loss. The gain to profit or loss, that is 121. 121. Gain to the profit or loss. So we do the last part. We do the last part of that question. Using suitable computations, explain the accounting treatments of the change in fair values in the year 2024. Explain the accounting treatments of the change in fair values. Explain the accounting treatment of the change in fair values in the year 2024. Already we have talked about the change of this. Gain to profit or loss. Gain to profit or loss. Gain to profit or loss. So let's look at this Roman 2 of the same question. Let's look at Roman 2 of the same question. We see how we were supposed to handle that question. How we were supposed to handle that question. So that is E, but now Roman 2. So we say that gain between the two periods, and so we say that gains between the two periods, between the two periods, and based on what? And based on a price, based on a price change, based on a price change, and a physical, based on a price change and physical, on a price change and physical what? Physical change. Based on a price change and a physical change. So we can say price change. We say price change is equals to change. Is equals to change in price. Change in price of biological, change in price of biological asset, of the biological asset over periods prior year estimate at current price. We have everything on that side, most of them. At current price. So change. So that is so this one will be so change in price of biological asset over periods prior year estimate at current price. Prior year estimate at current price. Which is equals to that present value, that is 165. Change in price of the prior assets. Yes, change in price of the biological asset over the period prior year estimate at current price, which is 165. 165 times 1 plus what? 1 plus R. 1 plus R, which is equals to 1.06 raised to what? Raised to that one. Yes. Change in price of biological assets over the prior years. That is change in price of biological assets over periods. That is over periods. Prior year estimate at current price. And so this one is equals to 165. You divide 1.06 raised to 20. That is, you will get what? So 1.06 power 20 times, that is so 165 divided by answer. So you get 51. So this is 51.45. So of which 100 number of trees times 51.45, you get 51 what? 51.45. 51.45. So that prior year estimate at the prior price is equals to the 53.32. This one here. The prior year estimate at the prior price, which is 171. We don't have to do it again. See, that is what we did here. Prior year estimate at prior price. The prior price, the 2023. So remember that this is 2024. This is 2023. That is 53.32. Meaning that these are lows. For this one, these are loss. These are loss. Because the previous year is more than the current year. So that 53, 32 minus what? 51.45. Which is equals to what? A loss of 187. Then you will come to say physical change due to maturity. So physical change due to what? Due to maturity. Physical change due to maturity. Physical change due to maturity. So current year estimate at current price. So we start with current year estimate. Current year estimate at current price. Current year estimate at current price. Current year estimate at current price. That one is current year estimate at current price. So remember that current price, that is 2024, is this one here. The 54 what? 54. The 54, 53. This one, the 54.53 at current price. Current year estimate. So the physical change due to maturity. Current year estimate at current price. So this is the one. Current price is 165. So the physical change. Remember that after the change in the year to maturity. Remember that in 2023, the age of the trees was 10, but by 2024, now there was a change to 11. So that years to maturity, it changed from 20 to 19. So physical change due to maturity. So current year estimate at current what? At current price. Then prior year estimate overstated at current price. Prior year estimate overstated at what? Overstated at current price. Overstated at current price. Overstated at current price. Overstated at current what? Current price. Overstated at the current what? Overstated at the current price. Overstated at the current price. So we have said that prior year estimate overstated at the current price. So this is the one. Overstated at the current price. This one. The 51.45. So that is the prior year estimate, which is 165. Overstated at what? The current price. Prior year estimate. Overstated but at the current price. This is the one. The 51.45. So that here I can see we have again. We have again. So the difference 53 minus 51.45. That is 308. That is the 308. So the 300 and what? 308. So I need to mention something. So there's something I need to mention. So this one, this gain, so gain, this one, to be posted where? To be posted, or which is credited, to be posted to the income statement, to be posted to where? To income statement. That is income statement. That is, it's credited. That is credited in the income statement. To be posted in the income statement. To be posted in the income statement. So that is how you were supposed to do. E part what? Roman 1 and Roman 2. Remember that this is Roman 1. Even if there's some formulas, then this is Roman 2. It was having 6 marks. They were marking this. Yeah, they were marking answers, by the way. So if you scored this, that one, then they mark this one. That is that and that one. And also they mark 121. So they needed any two. So you can see 1, 2, 3. So this one was having 4 marks. So any out of the 3, any 2 times 2. Get your 4 marks. That is E Roman 1 part of it. So they were marking this, and this. So any 2 times 2, you get your 4 marks. Then this one was having 2 marks. This one was having what? 2 marks. So also this one, they were marking this. This. Then there is this one. Then there is this, there is this. Then there is this, and there is this. So any words? Anyone, imagine anyone you could have mentioned. Any of the 1, 2, 3, 4, 5, 6. Anyone, they multiply 2, you get your 2 marks. Any of the one you could have mentioned out of this. Anyone you could have mentioned, they multiply by 2, you get your 2 marks. Get your 2 marks. So that is how you were supposed to do. That is how you were supposed to do. This question number 1 for the August what? August 2025 sitting, financial reporting and analysis. So this one means that I have covered the 5 questions for that sitting. I have covered the entire paper, which you can use for your revision. So I have covered question number 1, the entire question. Question number 2, entire, including theory. 3 the same, 4 the same, 5 the same. So we have done the entire sitting for question number 1. That is the entire sitting for the August 2025 sitting, financial reporting and analysis, guys. I think, guys, you know that I do Zoom classes during evening hours, of which you can join. The classes are ongoing. We do them during the evening hours, 8 p.m. to 10 p.m. 8 p.m. to 10 p.m. So if you want to join, you know my number, which you can WhatsApp or call. I provide more information on how you can be admitted. So my number is this one. Then my number is, you can use it well. You can use it well. I know there's other students from Rwanda. For the Rwanda students, you know that you have to say this way. So I know there's also guys advanced financial reporting. So now I will be starting doing the RAS sitting paper for the advanced financial reporting and analysis for August 2025. So my next videos you will be seeing is now for the advanced financial reporting and analysis. Also, we'll be able to cover the 5 questions for the August 2025 sitting. Thank you for attending, and also subscribe to this channel and share this video to other accounting platforms, to other accounting platforms, to other accounting groups, so that I think it can benefit other students who are doing the same, but who are not aware. So thank you, and welcome to the online classes. That is the Zoom online classes.